Good morning, everybody. Welcome to the middle of March. I can't believe that we are almost a quarter into this new year. And seeing as though a lot of us have our start of our financial year at the beginning of March, now would be a very valuable time to start looking at cash flow planning. Or in other words, planning the way that the money comes in and goes out of our businesses. In our lockdown sessions during March, April last year, I presented a session on the difference between cash flow and income. So I'm not going to go through all of that stuff again. What I want to reiterate today is why cash flow planning is important and how you can go about doing cash flow planning. So I thought I'd remind you of this saying, which is so relevant and is so important to remember. Turnover is vanity. In other words, sales is nice to have, but the reality is that the money that we make from sales is still not our money. Profit is sanity, meaning that what is left over after we've paid all our accounts keeps us sane if there is some money left over. But the reality of business is cash. Turnover is vanity, profit is sanity, cash is reality. Meaning that if the rands and cents aren't in our bank accounts, especially at the end of the month when all our payments are due, who do we not pay? And because many of us are small business owners, often what happens is we end up not paying ourselves. And why are you in business if you can't even pay yourself? So let's talk about how we can plan or how we can prevent that cash becomes this burden that we are fighting every single month to get into our bank accounts. So there's three main reasons businesses fail. The first one is bad management, and this relates mostly to bad planning, the management of people, that you have unhappy employees and that causes ructions, bad customer service because your employees are happy. So all of the things relating to how you run and manage the business. The second reason businesses fail is that the expenses exceed the incomes over the medium to long term. So insufficient profitability over a longer period of time will lead to business collapse. And the third reason businesses fail is because of cash flow problems. Now, I've worked extensively in the franchise environment and within the franchise environment in the restaurant and fast food space. And I can tell you one thing that I've noticed. If a business is going to fail, it often happens fairly early on in the life of the business, if it is going to be because of cash flow problems. And the number one reason that happens is that the new owners didn't plan their cash flow well, or that they used too much of their cash for nice to haves or for their own salaries or drawings instead of plunging or keeping the cash in the business to make sure that it runs effectively. So those are the three big reasons. And I wanted to reiterate that because it just illustrates again how important cash flow management is. So let's look at what can cause cash flow problems, because that can help us manage and plan for those things. So the first reason, and I just mentioned this as well, is too much of the profit is taken out of the business by its owners. Often when you start a new business, you think that you need to have a certain amount of money to keep in your personal capacity, and you draw a nice fat salary and you keep on drawing that nice fat salary because you're used to it. And before you know it, you've actually depleted the cash reserves of the business. Or instead of a nice big salary, you just spend too much money on issues that aren't necessarily 100% necessary within the business. If you expand too rapidly, and this can happen to existing businesses, where all of a sudden there's a big demand, and because of the big demand, you think, okay, let me employ a new team, let me get a new vehicle, employ 2 or 3 people to operate that team, buy all the equipment that needs to be there, and by expanding rapidly, you've now invested a whole bunch of money, and if you can't sustain the incomes or the incomes aren't cash incomes. Maybe you've got got a big project and you gear up and you put more teams together, but the project is only going to pay you in a month or 2 months time. So you've got that huge outflow of money in the beginning, but the money is only going to come back in 2 or 3 months time. So too rapid expansion can also cause cash flow issues. Don't get me wrong, you can expand. You should expand when the time is right. You just have to plan better about how rapid expansion, or any expansion really, will affect the cash flow of your business. Poor cash flow planning, especially when it comes to investing a lot of cash to get the business going or growing. I just want to, before I talk about sudden drop in sales, the failure of a major debtor. This is huge, especially if you're working on projects in your businesses specifically. If you've got a contractor, for example, that you have a contract with, you invest a lot of time and energy and resources into plumbing a project or a complex or something that they've given you, and then they can't pay you. Either the builder goes bankrupt, or they are a shyster and they don't pay you. So if you have a major debtor that fails to pay you, that can cause massive cash flow issues as well. Or even if the debtors take too long to pay you, can also cause cash flow issues. Now, if you have debtors that you know take long to pay, but you're still willing to do the work, you can always plan for that. And just run your business a little bit differently from a cash flow point of view. Obviously, when you have a sudden drop in sales, that will affect cash flow. When you've got large amount of money tied up in stock, and maybe the stock isn't moving, I think in your case, you probably don't carry too much stock, but you could be if you're working on a project. So it is important to kind of balance the keeping loads of stock that you're working with on a project versus buying as you need. And then the final one, extraordinary demands on a business's cash reserves. And COVID and the lockdown was a really good example of an extraordinary demand on businesses' cash reserves. And the businesses that saw what was happening and that saw that there was changes coming and that business was going to drop, and put plans and kept some cash reserves and cut where they could cut, they are the guys that are still going now. The guys that are blissfully just carried on trading in the way that they normally would have, trading with their money as the way they normally would have, are the guys that didn't make it through or are still struggling to get back on their feet. Okay. So remember, our income statement looks at our income minus our cost of sales. That gives us gross profit, minus our expenditure gives us net profit. With our cash flow, what we're looking at is the cash in the bank, the cash coming into the bank, and the cash going out of the bank. So literally, our cash is reality. It's all about understanding how the cash in the business flows in and flows out. So if we're looking at cash in the bank, what is the actual rand value of the cash in your bank account? And then when we are planning, remember that our cash flow forecast is a forecast, and it's what we think will happen in the coming months. So when we are planning, we are basically budgeting for how much cash are we going to receive in the following months. And in our cash flow forecast, we're actually going to take our cash receipts and break it up into actual cash receipts from cash sales versus receipts of cash from our debtors. Because you might have made the sale this month, but the money is only going to come in next month. So you allocate the receipt into the time period you expect to receive it. That gives us cash in bank, and cash receipts gives us total cash available. Then we're going to look at our total cash outflows. Our total cash outflows is the sum of our cost of sales expenses with our operating expenses. So this is about when you actually pay for the invoice. So you allocate the cash outflow when you pay the invoice. Whereas in our income statement, the invoice might be allocated in the month that you receive it, but you may not have paid it yet. Okay. So remember, this includes all payments, not just income statement payments, which means it's going to include things like asset purchases. If you're spending 10,000 Rand on a piece of equipment, that's 10,000 Rand that is leaving your bank account. So you're going to allocate it in your expenses or your cash outflows area. It will include things like loan repayments, which is not included in our income and expense statement, but it's money leaving your bank account. So if we have our total cash available minus our total cash outflows, at the end of the month will give us our total cash available, and that then becomes your total cash available for the following opening month. Okay. So remember that your profit might be 2,000 Rand. On paper, your profit might be indicated as 2,000 Rand, but the question you always have to ask is that 2,000 Rand in your bank account? And the chances are probably it is not, because the cash has been coming and going. And also remember that for our cash flow forecasting, we include VAT. So in the income statement, the numbers are exclusive of VAT, but in our cash flow forecasting, we want to include VAT because we are receiving that money and we are paying that money. So, and VAT payments can have a massive impact on our cash available. Okay, so I have an Excel spreadsheet that I actually shared during the COVID sessions, and I'm more than willing to share it again. And it has a little cash flow forecast included on that is user friendly and that you can play around with the numbers. So if you guys need that, I'm more than willing to share that with you again. But I thought, let's just play around with a few numbers to illustrate what I'm talking about. So our cash flow forecast always starts with a beginning cash balance. So let's pretend there's 50,000 Rands worth of cash in your bank account. Then you receive cash into the business through debtors payments, and you receive cash into the business through cash sales. So our beginning cash balance and our total cash inflows gives us our available cash balance. So this business starts off in the month of April with 60,000 Rand. They pay money out. So for this example, just to make it easier to fit on the screen, I have consolidated the expenses quite a lot. So don't think this is the only expenses that your business will incur. I've just made it a little bit smaller so it's more visible on the screen. So you pay a whole bunch of money out, which gives you cash outflows of 63,500, which gives you a cash balance of minus 3,500. So this business is in the red at the beginning of their operations. So your closing balance for this month becomes your opening balance for next month. Now we go and we plan what is going to happen in our business. So we're going to have our debtors are going to pay 60 grand. We are going to make cash sales of 25,000 Rand. Gives us 71,000 Rand over here. So how come we're in the red in month 2 here? So you will notice here there's a huge amount that has gone into total finance administration, and we've got this extra tax and VAT. Okay, so because this business has now got VAT every second month, you'll see what happens with VAT is it's every second month. You can see the impact that it has on the cash flow going forward. So if you look at the top here. So what we are literally saying is that if we plan to do these sales, it might not be enough to sustain this business over the period of time. So from a cash flow planning point of view, there's two things that we have to look at here. First thing is, should we be doing more sales? So we have to start looking at putting a plan in place to make more sales, or is there something that we can do to this total finance and administration over here? Why is it double every second month? So what's happening here that is impacting on our expenses so much? So you can see from these numbers, this business is going to run into cash flow trouble. So it's not the end of the world, but if you know that it's coming, you can do something about it. Okay. So I just played around with a few numbers. What would happen if we now reduce our income from 60 to 50, and then it starts looking even worse over here? You can see the reds over here. So what's interesting is that sometimes you just go over and you go back in the black, but if you don't make a plan, you're going to end up back in the red over here. So the point really is to play around with the numbers and make sure that you can see what is coming your way. So that's really why we do these numbers. Okay. Sorry, that slide was a terrible slide. It didn't have all the numbers correctly. So you can see that we've got some troubles coming our way over here. So you might be okay in July, but come August, we're going to be back in red. That should be 50, not 5. Okay. So what has caused this red over here? And this is one of the things that I want you to play around with when you do your cash flow forecasting, is look at your cash flow and say to yourself, okay, what am I planning to do in the next month or two? I have to go and buy a piece of equipment that's going to cost me 10,000 Rand. Can the business afford to buy this piece of equipment for 10,000 Rand? If I put in 10,000 Rand in May, well, look what it does to my cash flow here. That's a concern. Because if I get to the end of the month and I'm minus 20,000 Rand in the red, how am I going to fix it? Where's the money going to come from? So maybe I can't afford to buy that piece of equipment right away. Or maybe what I should do is make a plan from a cash flow point of view. So either finance that piece of equipment, and then you can say, okay, let's take the 10,000, break it up over 5 months of 2,000 Rand each, plus interest. So it's going to be a little bit more than 2,000 Rand a month. Can the business afford to pay that? Play around with the numbers and have a look. Okay, so when you've done your cash flow plan, you've played around with the numbers, you've inputted different scenarios. A great one to play around with as well is to change salaries. So if you plan to pay bonuses or you want to give the guys increases, then play around with the salaries. Have a look at how is it going to impact my cash flow. Then you have a plan. You know when your cash is going to be high, and you know when you might run into cash flow problems. So what are the things that businesses can do to boost their cash flow? So I was just talking about buying equipment, but you can boost your cash flow by replacing old equipment and inventory. And I'm just going to give a silly example, and I'm hoping this isn't your case. But if you've got a really, really old vehicle and it breaks down every second day, and you end up not being able to send that team out because the vehicle isn't working again, it's like our police stations, they can't send teams out because the cars don't have fuel. Maybe a good idea is to replace that old piece of equipment. Yes, it will cost you money, but over the long term, that team with the good equipment is going to be able to deliver properly on the job that they're supposed to do. So replacing old equipment and inventory that you can't sell could boost cash flow. Reevaluate and fine-tune the pricing of your products. And when I'm talking about pricing, it could also be that your pricing stays the same, but in order to get people, especially if you've got contracts, in order to get them to pay sooner so you can boost your cash flow, is to charge them the normal price, but give them an early payment discount. You can renegotiate long-term contracts. I know many of you have got existing contracts with contractors or corporate companies. Guys, it's standard business practice to renegotiate contracts annually. So have a look at which of those you can relook the pricing on those contracts, relook the terms and conditions, because that is a great way to boost your cash flow. As I said, in terms of pricing, create incentives for early payments and penalties for late payments. Improve your marketing. Marketing costs money. It is, however, the best investment you can make in your business. But what you don't want is to be spending a whole bunch of money on marketing, which isn't giving you return. So you want to measure the marketing that you're doing to make sure that you are getting a good return on that investment. Add new products or services to your business, maybe small add-on services or small things that you can do for your clients while you are out there, and be able to boost the cash flow a little bit, and getting a loan. So I want you guys to think for me quickly. If in your business, have you or do you want to do any of these things, or have you done any of these things in the last few months or in the last year? And if you guys will just either in the Q&A section or in the chat box, if you are able to just type for us, give us an example of something that you have done over the last few months or year that has enabled you to boost the cash flow of your business. Or maybe you tried to do something, but it didn't work. I think this is a really valuable space for us to be able to share that knowledge with each other. So if you go onto your little ticker at the bottom or the top of your screen, click on more, you'll find the chat button, go into chat and type in anything that you have done that has worked, or if you go into our Q&A, that's also fine, whatever's easiest for you. Type in anything that you have done to boost your cash flow, something that has worked or something that has not worked. So while you're doing that, I'm just going to quickly talk about getting a loan. Getting a loan is probably one of the easiest but hardest ways to boost cash flow. And I always say the following when it comes to getting a loan. When you need the money the most, the bank is not going to give it to you, because they're going to look at your financials and go, but we can't give you any money. You can't afford to pay us back. So you want to ask for money from your bank before you actually need it. And that is why cash flow planning is so extremely important. If you ask for the money, if you've done your cash flow planning, you've done your forecast, and you see that you're going to run into the red in the next few months, you go to your financial provider and you say to them, I see I'm going to run into a bit of trouble here. Can we make a plan? Normally, if it's a short-term problem, the bank will supply you with an overdraft facility. And sometimes it would even be a temporary overdraft facility. So if you can go to them and show them from your cash flow forecast, this is where I'm going to run into trouble, they will give you a temporary overdraft facility or an overdraft facility to carry you through that period. If you need money to buy equipment, that will probably be asset finance, but they will still need a cash flow forecast for you in order for them to give you money. So getting a loan is the easiest, but also the hardest way to access funding. And your bank is going to want to see your cash flow plan. And remember, you want to go and ask them for the money before you actually need it, because once you need it, it's too late. You're not going to get any money without a cash flow forecast. So cash flow planning is extremely important. Okay, that's me for today. Thank you very much for your time and your ears. Thank you, guys.